So today we're going to be going over what I believe is one of the safer investments as far as getting exposure to the AI space, and that is Taiwan Semiconductor Manufacturing Company. So this business is what I consider one of the safest because no matter what's going to happen with AI, this company is still going to be the company that just about all the other computer chip semiconductor manufacturing companies are using to build their chips. So their business model is simply to be a semiconductor foundry, which means they just simply build computer chips based on the designs of other companies. So Apple, Nvidia, Qualcomm, Broadcom, a lot of those very popular and well-known businesses who are growing so much and investing so much when it comes to the AI space, they make their designs, and this is the company that develops their chips. This company is building about 62% of all the chips that are designed around the globe. And when it comes to the high performance chips, the AI chips, the quantum computing chips, they're producing about 90% of the high performance ones. So this company has a very dominant position when it comes to foundries and building semiconductors. And this is what I say as far as getting exposure to AI is one of the safer investments, because no matter what happens with AI demand, even if AI demand doesn't skyrocket as expected, we're still going to need computer chips for all the electronics that are developed. And this is the company that's going to be manufacturing most of those chips. So the investing department is my platform, and this is where I'll be launching and posting many of my stock analysis in the future. So check the link in the description, sign up for the newsletter. You'll get at least one of these per week where I break down stocks the way I do them if you are a fan of my videos. So I'll be sending one to you every week. I'll still post videos, but there'll be more of these analysis being posted to my website versus analysis videos in the future. So some of the ones that I'll send, some will have videos, a lot of them will not. So if you're interested in getting these directly sent to you, check out the website, link in the description, the investing department. So let's get into the stock analysis for this company. Ticker symbol TSM, Taiwan Semiconductor Manufacturing Company. So a few quick notes. Number one, if you were to look at their financials, it's a foreign stock. So they file what's called a 20F. That's equivalent to what we would call the 10K in the US, their annual report. So when I look at that, it is in their currency, the Taiwanese dollar. They are trading on the Taiwanese exchange, not the US exchanges. So there was currency conversion that I had to do to get these numbers equivalent to US dollars so we can get a look at what they've performed at when it comes to in our currency. So with that said, in 2016, 30 million in revenues, 2025, 120.8 billion in revenues. Very strong growth, only 1 year of negative revenue growth in 2023. But with that said, over the past 5 years, 24.4% growth rate, pretty solid. 21 over the past 10 years, we see the AI spike contributing that 3% there. Looking at margins. Now, this is a manufacturing business. They don't design, they just have heavy capital expenditures. They have equipment. They build chips based on other people's designs. So they have a very capital intensive business. Most manufacturing companies, they are happy or lucky to get 30% margins, meaning, and I mean gross margins, meaning once they deliver the product or service to the customer, what they have left over is 30 cents on the dollar. That is a solid mark for many manufacturing businesses. This business, 50% 10 years ago, 59.9. They're at 60% gross margin. So once they deliver the product to the customer, for every dollar they bring in, they're walking away with 60 cents to cover the rest of their expenses, which is a great mark. Great to see very strong margins in improving of those margins over the past few years. Amazing. Net income, 10.5 billion to 54.5. Look at this. Net income ratio, 35% to 45%. Now remember, some manufacturing companies are lucky to get to 35% when it comes to gross margins. This company is walking away with 45 cents on every dollar after all expenses are paid. These are amazing, very strong margins for this business. So revenue trends, margin trends, very solid across the board. Only 1 year of negative growth, but right after that, they rebounded to 33 and 31% growth. So they really didn't put a damper on the parade at all. Still solid growth this business is growing at a great rate. Looking at their debt to free cash flow, I want to know if the company were to get into trouble and they needed to pay down debt, how fast can they do that? How strong is their balance sheet? This is one of the most important metrics, I think, when it comes to assessing the balance sheet. Looking at debt, 4.8 in 2016, 29.4 in 2025. Free cash flow growing at a great rate. Right now they can pay off their debt in less than a year. That is amazing leverage. I love anything less than 3 years. I'll accept things less than 5 years, but great leverage. 1.4 over the past 5 years, 1.3 over the past 3 years. So on average, a year and a half, they can pay off all their debt. Very strong leverage position. This gives them a lot of flexibility to reinvest in the business. They do pay a dividend. So let's look at the dividend. One thing to note, like I said before, they're on the Taiwanese exchange. So this is a foreign stock. If you were to buy this stock on a U.S. exchange, you're buying what's called an ADR. It's a certificate issued by a United States bank that represents ownership in a foreign stock. So I say that because if you were to buy this company, the dividend on this stock is going to be about 25%. That's the foreign tax dividend. So this may not be income stock or a dividend growth stock for you because of that reason, because of that higher than what we would consider average tax rate. Because for most of us, we're paying 15% on dividends that we're holding for a long period of time. But if you were to buy this stock, you got to pay a 25% rate. With that said, you don't have to pay the U.S. tax because you're already paying the foreign tax, 25%. So keep that in mind. They do have a dividend, but this may not be the dividend play for you for that reason. So looking at their dividend, they do pay a dividend. It looks like every quarter, but it's a different amount every quarter. Typically, when a dividend is issued by a business, they pick a number. It's going to stay at that amount for the year, and then next year they'll announce a raise. This company just announced it per quarter based on operations. So it is growing, but with that said, they do have some years where it either stays flat or go down a little bit. So we have, let's see, 39, 38, 36, 34, 35, 36, 35, 37, 38. So it took a couple of years before it to get back to that 39 cents. Then it jumped to 44, it went down to 43, then it went back up. So you are getting a dividend every quarter. So you're consistently giving a dividend, but the dividend amount isn't as consistent. However, you should expect it to grow because the company is growing and they have a high probability of continuing that growth. So the dividend should grow, but it's hard to estimate exactly how much. Now, with that said, 42% of their free cash flow is paid out in a dividend. So they're in a dividend growth position if they choose to do so. But I don't think that's going to be happening in the future because of some of the reinvestment plans that they have. Let's see, shares outstanding, not much there. They have shares that are coming down. So we do have a downward trend. So we like to see that a company is adding value to the shareholder by purchasing shares. However, if you look at the amounts, the trend line makes it look more drastic than it really is over the past 6 years. So there is a downtrend. That's positive. It's not very strong, not very significant. So there's nothing to really see when it comes to that. Going to the value added. A company has capital. They have debt and equity. They have cash on their books at their disposal to put into their business to get a return. What's that return compared to that capital? And what does it cost you to hold that capital? You want to make sure you're returning more than it costs you to have it, okay? The interest on the debt and the opportunity cost of investing that money into the market or investing with a treasury bond. So looking at that, we have a spread of 15.2, 24% return on capital compared to the 8.9% cost of that capital. That's a great spread of 15%. Now, this is a manufacturing company, heavy capital intensive business. So for them to have this spread of 15, when many of the people in the semiconductor and the manufacturing equipment space, they are beating some companies that only design semiconductors, and they have the equipment to manufacture it. So this is a great sign that they have a great management team making great decisions and deploying capital the right way for them to have a 15% value spread when a lot of companies or the rest of their competitors and people in their space are at 12%. So this is a great sign for this business. Solid all the way around. So let's look at the valuation for this business. I believe their current price at $411 is pretty much spot on and right in the middle of what I consider to be their fair value range. So let's see how I got there. I'm assuming a 27% growth rate over the next 5 years. Remember, they were averaging about 24% over the past 5 years. So I'm assuming that will increase about 3% per year over the next 5 years to be at 27. Their hurdle rate, 8.9%. I think their cost of capital is what they need to earn to get a return. And again, they've been at 24%. So they've been superseding that by a lot. So I'm assuming an 8.9% discount rate, 33 times free cash flow. So what I use this for, how much money could I expect to get if I were to sell the stock in 5 years? That's my terminal value. Over the past 20 years, they've traded at an average multiple of 33 times free cash flow. And I believe I can get at least that if I were to trade this company in 5 years. That's what I'm assuming. Looking at free cash flow of $34.4 billion, that puts me at $410 as my fair value estimate, just below their current share price of $411. Right in the middle of my range. Low range, I got 369. High range, I have 451. So they're right in the middle, right at fair value, in my opinion. So let me know what you guys think about this analysis. If you own this company and what you like about this company, I think it's one of the safer bets. Like I said, no matter what happens with AI, this is the company that all the other design companies are going to use to develop their computer chips. Now, another thing to note, the free cash flow right now is $34.4 billion in US dollars. It's going to drop because they're going to be using a lot of their cash for heavy investment to build a foundry on US soil. So they're building or expanding the current facility in Phoenix, Arizona, so they can expand the chips on US soil. So we have chips that are being built on our soil away from the threat of Chinese invasion of Taiwan. So $165 billion is going to go into that investment over the next few years, and that's coming out of the free cash flow. So their cash that they generate should grow, but what's going to be considered free cash flow is going to drop just because the management is choosing to put that money that they've earned into the business. So this is what I would call normalized free cash flow. The normalized free cash flow is going to grow, but because of the heavy investment where they're adding value to the business, that is going to come down. So we're not going to count that against them when it comes to the future. When we look at their future financials, we should expect this number to come down, the free cash flow, but you see that construction in progress number to go up because they're putting billions into building that foundry, or expanding it, I should say. Adding value to the business, allowing them to develop more income and cash flow for the future. So all around, I see this company as being a solid investment, in my opinion. So definitely one that needs to be on your watch list if it's not already on there. So let me know what you think about this in the comments, and I hope to see you in the next video. And remember, check the link in the description for the investing department, where I will send you one of these stock analysis straight to your email every week. See you in the next video.